Hello there. My name is James Bogart, Managing Principal of Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We are a fee-only financial advisory firm for our customers. Our clients' assets are held at Charles Schwab, and we're an investment advisor that overlays on top of it. We're true fiduciaries for our clients. Bogart Wealth's core specialties are financial planning, investment management, tax optimization, and tax preparation. There are 16 of us on our team now. We've grown a little bit. We have 3 offices, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Exciting news, next week we're actually moving into our new space in the Woodlands, Texas office. So we're going to be in the same building just up on the 12th floor. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. You know, your kids, your parents could be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. A lot of you have heard me say this before, but I do absolutely mean it. You know, what changes could you make now that you know what you know, but when you were back in your 20s? And with your kids, that can be some of the areas that we can have the biggest impact. And part of our culture is to give them access to certified financial planners. Now, one of the calls to action for many of these educational events that we do is to actually give you the offer to sit down for a one-on-one financial consultation. It's absolutely no cost, absolutely no obligation. One of the things that you'll probably learn from us is that we do have a high level of specialization within the ExxonMobil benefit plans, and definitely think that now is as good a time as any to establish a baseline, see where you're at with things, and it truly is no cost, no obligation. Now, today's talk is actually one that we've broken away from a bigger series of educational events that we do, but we do have kind of 8 core foundational events that we do, and I've been pivoting to do them web-based because that seems to be what the market wants right now. We are recording all of these topics, including today's. If you'd like to get a recording and be able to pass it around, feel free to do so. We're also going to be launching a new website here in the next week or so, where all of the recorded events are also going to be on that website. But we do one on the retirement planning timeline. We do one on retirement income planning, one on Social Security and Social Security strategies, one on tax planning and tax law changes, as well as tax optimization strategies. We do one on estate planning strategies, one on net unrealized depreciation and post-retirement income strategies, one on long-term care and long-term care insurance. And then last but certainly not least is Roths versus traditional 401ks and IRAs. You know, this list came from our audience. If there's a topic you'd like to hear us talk about, please feel free to let me know. At a minimum, I'll add it to an existing topic. And we do try to stay very timely as we're putting out new content. For example, we did one on the Secure Act. We've done one on the CARES Act. We talked about some things to do during this volatile market environment. You know, all of those are recorded. If you'd like to get a copy, please feel free, let us know. We'll send them over to you. So specifically today, I'm going to talk about how do discount rates affect the ExxonMobil lump sum plan. And before I jump in, I do have the question and answer box open as well as the chat function open. So if there's questions at any point in time, please feel free, interject, ask. More than happy. I'll do my best to answer them as they come up. All right, so as I dive in, we're going to talk a little bit about the Pension Protection Act of 2006. Now, the reason we have to talk about the Pension Protection Act of 2006 is because this is actually when government came in and actually determined the guidelines associated with any company that offers a lump sum option for their pension program. Now, the reason it matters for the ExxonMobil community, because it actually has created 2 categories of households, what we call grandfathered and what we call non-grandfathered. And the whole reason for the segmentation is because of the Pension Protection Act of 2006. Now, a couple of things that it did. It defined the discount rates that can be used. It defines the actuarial table that can be used. It also clarified some things related to non-pension elements. For example, non-spousal beneficiaries can do rollovers from retirement accounts. After-tax balances can be rolled over to a Roth IRA. It also clarified that company matches can be diversified. Many of you might know in order to get the extra 1% on your savings plan contributions, you had to have it go to stock. Well, after 2006, it clarified that you can still get the 1% and you can also diversify the investment options. And then the last thing it did was it defined IRA and 401k contribution limits. For today's talk, I'm going to really focus on kind of the top 3 parts of the Pension Protection Act and dive in a little bit deeper. So first, we'll talk a little bit about the grandfather category. So this is anybody that was part of the ExxonMobil benefit plan, or pension plan, excuse me, that is under the legacy math. And it was anyone who was over 50 at the end of 2007 and had 10 years of service before January 1st, 2008. And for you guys, there was no change in the rules. It was the old rules. You know, more simplistically, you were 55 and had 15 years of service by December 31, 2012, or your birthday was before 1958 and you were hired before 1998. Now, for this age group, the math is very, very simple, actually. You take 95% of the 30-year Treasury bonds, and they round it at the end of the quarter up or down to the nearest quarter point. The other thing with this age group is we use the ExxonMobil year 2000 mortality table. Yes, I said year 2000, so it has not been updated in 20 years. Now, with this age group's math, you can see, you know, just kind of the trajectory of the 30-year Treasury bonds. They've been going down pretty steadily and even more significantly in this more near time frame. And one of the things that we do every single week, Pete, actually, one of the members of my team, updates the projections for the rates, and we send them out. Whatever age category you're in, we send them out. Feel free, if you'd like to get on those distribution lists and you're not, just send us a note. We're more than happy to add you. But one of the things we're doing is we're tracking what these segmented, what the grandfathered rates are doing. And so right now, based on where the 30-year Treasury has been for the second quarter, which is going to be determining the fourth quarter, we're actually projecting the fourth quarter discount rate for anyone who's in the grandfather category to be at 1.25. Now, in the third quarter, it was at 1.75. In the first and second quarter, it was 2.25. Now, if we do close out where rates are currently at, we will see a new historic low for the grandfather category at 1.25. Definitely something to consider. One thing I should have probably said at the beginning is these discount rates apply to just the decision related to a pension lump sum. It's one of many decisions that we're going to need to make regarding retirement, but something to be mindful of because we'll talk about the sensitivity to interest rates as they start to rise here in a few minutes. All right, so before I talk about the sensitivity, I want to talk about the other category. This is everybody else. And so this was anyone who was under the age of 50 before December 31, 2007, or you were just born 1958 or later or hired 1997 or later. Now, the math for you guys follows the Pension Protection Act. And so this is the new rules that were instituted that actually clarify that you need to use 3 segmented high quality corporate bond yields. Now, the math for this age group is a little trickier because it's actually tracking AAA rated corporate bonds, which actually don't really exist anymore. So what we're having to do is rely on when the IRS publishes every single month what these rates are going to do. Now, another thing that Pete does for us is we actually help build out projections of what we believe these rates are going to be. It's a little risky in the sense that we're projecting based off of what we're seeing the trends from different data sources, but it's another thing that we send out every single week to kind of give you an indication, at least at a minimum, of what the direction of the rates are going to be and how they're trending. And we get the official numbers every single month. Now, with these segmented rates, it's 3 rates, segment 1, 2, and 3. Segment 1 is mirroring short-term high-quality corporate bonds. It applies to the first 5 years of a pension. Segment 2 is basically replicating intermediate-term corporate bonds. It applies to years 5 through 20 of anyone's retirement. And then segment 3 applies to anything else up to the mortality table. Now, for the all other category, the mortality table is published every single year by the IRS. Now, obviously, since people are living longer, mortality tables have been getting older. That's actually benefiting this age group. And we compare that to the grandfathered folks, which, if you remember, I said that mortality table hasn't been updated since the year 2000. Now, here's a chart that's showing what the trend is for the discount rates for all 3 of these segments. Segment 1 is the green, segment 2 is the blue, and segment 3 is the orangish red color. And what we're modeling now is that all 3 segments have actually dramatically come down going into the fourth quarter. Now, one other thing that I got to mention for this all other category is the only months that matter in terms of determining what the actual discount rates are are the last 2 months of the preceding quarter. So May and June are what determine the fourth quarter interest rates. And when we start modeling the first quarter of 2021, it's going to be based solely off of August and September. July is not going to have any bearing other than telling us what the direction or trend of those rates are. Now, what's interesting and what's happened is going into third quarter, so specifically looking at February and March's interest rates, we were predicting a very dramatic decline going into the third quarter because of what was going on with corporate bonds at that point in time. Now, ultimately, the volatility that we saw in the month of March caused rates to spike back up at the end of March, which still brought the overall discount rate down, but it wasn't anywhere near the level that we were anticipating initially. Now, what's happened is as things have calmed down, markets have kind of gotten back on track, and ultimately I have to give a lot of credit to the Fed, as the Fed has become a massive buyer of high quality corporate bonds. It's actually caused the rates to really dramatically trend down again, which is what we're seeing happen now. So this is the other tool that Pete's built out, which is really, really nice. And again, first quarter will determine the third quarter rates, just like right now we're in the second quarter and we're now projecting what the fourth quarter rates are going to be. And similar in terms of trend is what we're seeing with the grandfathered folks. We're seeing a similar trend with the non-grandfathered folks, which is a dramatic reduction going into the fourth quarter. And so what we're seeing is we're projecting, and again, this is a projection. We still have to go through the rest of the month of June in order to get here. But as it is, as of Friday's close, we're now projecting a 66 basis point decline in the fourth quarter for anyone who's in the grandfather category and retiring at the age of 60, and a 63 basis point decline for anybody who's retiring at the age of 55 in the fourth quarter. So for anybody who's kind of been looking at third quarter, which I know a lot of people were, we're now a big proponent. Go ahead, you keep flexibility and options, but I think you should delay commencement of your benefits into the fourth quarter based on the trend that we're seeing happen with interest rates. Now, again, a lot can still happen with the last 3-ish weeks of June, but I would say it's a relatively safe assumption that we're going to see a lower discount rate in the fourth quarter than we saw in the third quarter. The trend is absolutely indicating that way. And again, this is another tool that we send out every single week. If you'd like to get on that distribution list and see how the rates are trending or what the trajectory is, please feel free to let us know. We're happy to just add you to the list. Now, one of the things we wanted to do was kind of just give you an example of how these lump sums are calculated. And this is just giving a theoretical $1 million value. And it's using the third quarter rates because we actually know the third quarter rates. So segment 1 was at 1.98, segment 2 was at 2.9, segment 3 was at 3.54. And what we know is that this example is using a monthly annuity amount, single life annuity of $4,910.82 per month, translates over to $58,930 a year. And this is how they actually determine the lump sum value. And again, illustrative purposes, but it gives you an idea. So basically what they do is they take the monthly annuity amount, they apply the discount factors, and then the discount rates, and then they apply a discount factor, so probability of receipt of payment. And then they determine a present value amount. And that's ultimately, if you add those up, that's how we get the lump sum value. And if you remember, I talked about how segment 1 applies to the first 5 years. Well, that's what this is indicating here. Segment 2 applies to the next 15 years. And then segment 3 applies to anything remaining up to end of life. And so we do know life expectancy right now is age 84. So we're modeling it out where it receives the annuity through the 83rd year. Now, for somebody who's retiring at 55, they're going to have more exposure to segment 3, which is the long-term bond rates. Very simple illustration. There's actually a more specific one. Another thing that Pete's done is helped us build out a very fantastic annuity projection tool where we can calculate some lump sum scenarios and also stress test or show modeling for different interest rate scenarios. If that's something you'd like to see as we go through the planning process, we're more than happy to do that as well. All right, so I wanted to continue on this example to kind of illustrate what is the sensitivity of these interest rates as they go up or as they go down. And I'm going to continue using that previous example with the $1 million. And this was looking at the first quarter 2020 with those current interest rates. And then what we're trying to do is show, based upon how much rates move, what does that translate to in terms of an increase or decrease in someone's lump sum value. Now, as we've talked about, rates are trending down, and anywhere from 50 basis points for the grandfathered folks. Right now, we're somewhere in the realm of projected decrease of 60 basis points for anyone who's non-grandfathered. Now, what we find is a general rule of thumb is a 1% movement in interest rates is about a 10% movement in the value of those lump sums, and that goes up and goes down. It's not totally linear, but it's pretty darn close. So, for example, if we see interest rates go up by 1%, then we're actually going to see that lump sum value go down by about 9.5%. On the other side, if we see interest rates go down by 1%, we're actually going to see the lump sum increase by about 11% roughly. And you can just see those values reflected here. So the point is with interest rates trending down, we absolutely will see lump sum values going up. I know a lot of you have felt very upset or uncomfortable because of the values of the 401k moving around. If it should give you any level of comfort, is that we are seeing the trajectory of interest rates going down, which is going to offset some of the impact that we've seen on the 401k balances being lower than they are today. Now, a couple questions we get a lot is, should I consider delaying my pension? Well, the answer is maybe. Everyone's going to be a little different here. And it really ultimately is being driven by what interest rates are doing, but also what age you are. And the reason this matters is because if you're under the age of 60 and looking to retire, ExxonMobil imposes a 5% per year discount for each year that you retire prior to the age of 60. So one of the conversations we have a lot of times is, hey, if you want to retire at 55, fine. Let's look at what's going on with interest rates. Let's also look at your cash flow plan to make that determination around, should we defer or should we go ahead and take the lump sum? So for example, if you don't need the money right away and we're seeing interest rates stay flat or trending down, well, if you're under 60, we definitely should defer. If you're over 60, we want to have a conversation if they're staying flat. And if they're trending down, we definitely want to leave it. But ultimately, if we see them trending up, we need to have a discussion around the timing of when we're going to declare that lump sum. So naturally, what we would say is, if you're going to take the lump sum and you expect interest rates to fall, we should consider delaying taking the lump sum. The other thing that we're doing, and part of our process, is we're going to help you build the roadmap for the timeline of when you should be executing certain steps. And the reason that we're doing this is because ultimately, when you get close to retirement, I like to use a football analogy, but we're now getting into the red zone. And that's the point that we need to be having flawless execution. We don't want any fumbles. We don't want any interceptions. We want to make sure that we are executing appropriately, and building out that timeline is going to help you with doing that. What we did here was just use an example of a December 31 benefit commencement date. And so the reason that we're doing this is we're showing the timeline. Now, the earliest that you can possibly request your package for retirement for a December 31 date, it's 120 days out. So that means August 1, theoretically, is when that window opens. Technically, it's actually August 3rd. But 120 days out is the soonest that you can actually request that package. And then at that point in time, it's taken them about 3 to 5 weeks to get those packages back to employees. It's a little bit longer if you have a qualified domestic relations order, quadro, if you had a divorce. It's also a little bit longer if you've had any period of time with separation of service. Now, once you receive that package, you need to actually go through that package and have it back to benefits 35 days prior to your benefit commencement date. Now, one thing I'll say with these packages is these are irreversible decisions. We want to make sure that we're doing them right. Have your financial advisor go through them with you. And hopefully it's an advisor who knows how to do these packages because, again, they are irreversible. Now, for a December 31 benefit commencement date, we want to have the package back no later than October 27, 2020. And then right before December 1st, usually it's December 1st or a couple days before that, you're actually going to receive the check. And then at that point in time, you either want to get the check delivered to the custodian, give it to your advisor, or deposit it directly yourself if you have the ability to go to the custodian. But you want to get that check in. Now, those checks are going to be made payable to whoever the custodian is. So if you're working with us, it's Charles Schwab for your benefit. They can only be deposited into the respective retirement account for you. Now, if you're fortunate enough to have a supplemental pension plan or an additional payments plan, there's some extra steps that we need to do. We would actually have forms completed as part of that retirement package that would have the funds actually deposited for those two respective portions going right into your checking accounts. Now, after we've done all of this, that's when we start talking about investment strategy. It's when we start talking about some of the other different buckets you might have. So for example, the savings plan. I would tell you that the default should be leave the savings plan at Voya until you're comfortable with whatever your strategy is post-retirement. But the earliest you can possibly call to do that savings plan rollover is going to be typically about a week after you're officially retired. So if you're of the mindset that you want to retire and you want to get everything out of Voya as fast as possible, you're going to need to wait about a week. And this is another thing where you need to have a very comprehensive and detailed plan. Specifically, if you've got net unrealized appreciation, which are low basis shares, I have a whole webinar just on NUA. We need to know what that plan is, but we also need to know what we're going to do with all of the other buckets and how that's going to be treated from a tax perspective. Because, for example, you might have after-tax money that should go into a Roth IRA. No reason that should be rolled into a traditional IRA and not getting the benefit of the tax-free growth. But ultimately, the calls are taking anywhere from 30 to an hour and a half, 30 minutes to an hour and a half, dependent upon the complexity of your situation. Just be prepared for that. And we want to be on that call. We want to, or an advisor who knows how to do those rollovers should be on that call as well. Because ultimately, there's, again, irreversible decisions that we're making here. I've had a couple instances where there's been massive discrepancies, a couple $100,000 of discrepancies, where it's just been extremely beneficial to have us on the line, let us help identify where those errors are, and ultimately get it executed correctly. And then ultimately, once it's done, get all of those reporting documents to your advisor as well. Let them review them to make sure that everything we told Voya to do in terms of execution was done correctly. Because even though the execution might have been done correctly, that doesn't necessarily mean it was reported correctly. And we want to verify those as well. Now, with this is the timeline. It's just giving a little bit more specific dates of each one. As I mentioned, 120 days out is the earliest you can request the package. You'll want to be able or know the 3 key dates. So your last day of employment, your first day of retirement, and then your benefit commencement date. And ultimately, we need to have a discussion around what is the most appropriate benefit commencement date for you and your situation. Once we've requested the package and received it back in, we want to fill out all of the appropriate forms. So it's the lump sum annuity election form. It's the qualified rollover form if you're going to be doing the lump sum. There's an address verification form. And then if you have a supplemental or an additional payments plan, we're going to want to do the direct debit form. And then we're also going to want to do the non-qualified pension election form for any of those supplemental pensions and additional payments plans. As I mentioned earlier, we want to get it back 35 days prior to the benefit commencement date. So that'd be about October 27th. Once you receive the check, let's get it all in. And then afterwards, we'll start talking about the other benefit programs like the savings plan, et cetera. All right, so some strategies to consider now. As I mentioned earlier, no better time to do a plan. Let's look at all of the different optimization points and model some different scenarios. Whether you're trying to retire at 55, whether you're over 60, it's never too late or too early. Let's have a plan in place. Let's understand what your budget is. Let's understand what your cash flow needs are. And let's understand your comfort level with risk. You know, one of the things that I'm finding with this kind of transition to a post-COVID environment is people's risk profiles were tested more than ever before. And ultimately, those that had concentrated positions, i.e. too much ExxonMobil stock, they're really being tested as well. We need to look at what are your short-term needs, your intermediate-term needs, and your long-term needs. And one thing I would say is that if your goals and time horizon have not changed, your investment portfolio shouldn't change as well. We need to make sure that we've got the appropriate buckets in place for short-term, intermediate-term, and long-term needs. And we want to make investment decisions that are not out of fear or greed. We need to have more of a long-term strategy in place. I did have a question comes in. Is this specific to non-grandfathered? Don't the grandfather have the option of retiring December 31 by the last day of payroll, which should allow us to get next year's vacation? Thank you for asking that question. It's a great question. Yes, so each age group actually has some different nuances, and that's kind of why we put this star in here about let's discuss your benefit commencement dates. Yes, this was an example for a non-grandfathered person. Now, anyone who falls into the grandfather category, there is a specific rule that if these 3 key dates, the last day on the payroll, first day of retirement, and benefit commencement dates, all run in sequence, you can actually get the better of either or interest rates. So you get the better of the fourth quarter rate or the first quarter 2021 rates. Now, because you're able to stay on and have a benefit commencement date of January 1st, you are entitled to and eligible to receive your vacation pay for 2021. Now, this is very different than those that fall into the all other category. The all other category, in order to get the benefit of the interest rate for that particular quarter, your benefit commencement date has to be within that quarter. So December 1st benefit commencement date is the last possible benefit commencement date that you can have and still get the benefit of the fourth quarter rate. What happens is if you go anytime after December 1st, that means that your benefit commencement date is going to be January the 1st. And that then would mean that you're subject to the first quarter rates. Yes, it would get you the 2021 vacation pay, but you would be also subject to first quarter interest rates. So a lot of times what we're having to do, especially once we start knowing what the first quarter of 2021 rates are going to be, then at that point in time, we need to do a little bit of math in terms of what's going to be the most optimal timing for anyone who falls into that all other category. And that's where everyone's situation is going to be a little bit different because, for example, a 55-year-old who's got a lot of discount, that might ultimately erode some of it if they just continue to delay, versus a 62-year-old, for example. Well, ultimately, they're not having the discount imposed. They're just more subject to interest rate fluctuation. And then we have to do that math as well. All right. So for clarity, I was 53 in 2007, and I was hired by ExxonMobil in 2003. I think I heard I would not be in the grandfather category. Thanks. Yeah. Yes, that's correct. Because remember, if we go all the way back to those rules for grandfathered, you had to be 55 and 15. Well, excuse me, 50 and 2000 by 2007, and had to have 10 years of service by 2008. So because of the age got you there, but the years of service did not. So you would actually fall into the category of the all other section with these segmented rates. The only reason that would be different is if ExxonMobil gave you some type of special provision and grandfathered previous years of service from some other employment. I have seen that happen in a few isolated instances, but it's not very common. Great questions. Thank you very much. So that's actually the wrap up for today's meeting. I do have some upcoming webinars that I'm doing. On the 24th, I'm doing one on long-term care and long-term care insurance. On July 8th, I'm going to be revisiting this one as we'll have more clarity around what the fourth quarter rates officially will be. And then on July 15th, I'm going to do one on Roth versus traditional IRAs and 401ks. And again, shameless plug, but absolutely please take advantage of the opportunity for a one-on-one financial consultation. Absolutely no cost, absolutely no obligation. And here's the contact information for myself as well as my other team members who can help with getting you set up for any of the plan. But I would be delighted to have the opportunity and would love to continue to talk at any point in time. Thank you very much.